The center, defined as a focal point around which any object revolves. We, however, define the center to mean much more. It's where knowledge and ideas form a nucleus, where dreams intersect with possibility, a starting point from which your life can go anywhere. This is how we at Columbia Business School define the center, the very center of business. Here you'll find the center of opportunity, where world-class academics open doors to the world's most dynamic place of business, New York City. Come, learn at the center of knowledge, where top academic minds do leading-edge research on the latest business trends and innovations. Be at the center of access, where today's titans of industry spend everyday face time with students and faculty. Discover the center of convergence, where finance, fashion, media, healthcare, high-tech, and all industries intersect. Join the center of community, where high achievers the world over share an open exchange of ideas and perspectives. Dream at the center of entrepreneurship, where an Ivy League business degree gives you entree to the world's fastest-growing startup environment. And reach the center of global impact, where a network of over 40,000 alumni are creating real change across the planet. The very center of business, where all potential converges, where chances for success revolve all around, a place you just won't find anywhere else. Come, find yourself here, at the very center of business. Columbia Business School.
Live streaming from Columbia Business School in New York City. My name is Bruce Tang. Welcome to the final session of the 13th Columbia China Business Conference. Home to value investing, Columbia Business School is at the forefront of the theoretical development and practices of value investing. Given the ever-changing global dynamics and market uncertainties, what are the potential advancements on unwavering fundamentals of value investing? How should practitioners realize value investing in China? Joining us today are Professor Bruce Greenwald and Mr. Li Lu. Professor Bruce Greenwald is the founding director of the Heilbrunn Center for Graham Dodd Investing at Columbia Business School. He's a leading voice in value investing. Mr. Li Lu is the founder and chairman of Himalaya Capital, a multi-billion-dollar investment firm that primarily focuses on long-term investment opportunities in Asia and the US. He's a distinguished alumnus of Columbia, and Mr. Li Lu currently serves as a member of the Board of Trustees of Columbia University. Professor Greenwald routinely wins plaudits for his classes and has trained a generation of value investors, including Mr. Li Lu himself. Mr. Li Lu has in-depth knowledge about the Chinese market. His insights are trusted by investment legends like Buffett and Munger. Now, imagine yourself stepping into the most overcrowded investment classroom at one of the best business schools across the globe. Welcome, Professor Greenwald and Mr. Li.
Okay, thank you. I think this is going to be a rare privilege for everybody. I've known Li Lu now for more than 20 years, and not only is he a great investor, but he's a great conversationalist. So why don't we just start out by talking about how your investment philosophy has changed, because value investing is, after all, always an evolving field since you began the field literally, I think I would say, 25 years ago, 20 years ago?
More like 28 now. Time really flies.
So how has it evolved? So how have you been influenced by people like Charlie Munger and so on?
Yeah.
Go ahead.
Well, so before I started, I just want to, first of all, thank you for all the organizers of this great conferences. I mean, I look at the speakers are just really unbelievable. So the quality of the student has dramatically improved since I was a student there. So thank you for that wonderful work of putting together this great conferences. And it just really gave me such a pleasure to be on the same panel with my professor, Bruce Greenwald. In fact, I got into this field really because of Professor Greenwald's class. I think basically you got Buffett to come to speak to the student really roughly 28 years ago. And it was really out of that first lecture that I really got into this field. So thank you so much. And of course, I later, as a business school student, I took all of the courses that Professor Greenwald offered and learned a great deal. Made a lot of money too, so thank you. Yeah. So the philosophy is that it is relatively simple. The practice is really hard. So I wouldn't say the philosophy really evolved all that much for me. Before I got really exposed to value investing through Buffett's lecture at Bruce Greenwald's class, I think my whole approach to life was pretty much a set along similar lines. And so there's not much of a jump for me. The idea of buying something at a discount for something that really worth more is simply intelligent. So I would say almost all intelligent investing involves some kind of a value investing. And now the difference is that your focus on value evolves over time. And to different individuals, they tend to focus different areas of value. For me, when I first started as a value investor, this is now 28 years ago when I bought my first stock, I didn't really know much about business. I was born and raised in China during the Cultural Revolution. There was not much of a private business or market economy back then, so I had to learn everything anew. So at the beginning, obviously, I looked for value primarily on the balance sheet in the classic style of Benjamin Graham, looking for a cigarette butt, looking for the last puff, basically, looking for statistically cheap businesses and ignore what the business really is. And that served me well. And then over time, I evolved into understanding smaller businesses. And because I was just intensively curious about how business run. So much so, actually, I evolved into help funding or co-creating a dozen or so early stage startup companies. And that experience has taught me a lot about how businesses run, what constitute a good or bad or mediocre businesses. And so over time, I evolved into looking for really good businesses, small maybe, but really good businesses. And then that leads me to look for good businesses in Asia, and eventually for businesses with enduring competitive advantage with a long growth trajectory ahead of them. And so the places where we're looking for value evolves over time. But the basic philosophy have pretty much remained the same. It's just our core competence expanded over time. Now, I have been very fortunate to be influenced at the very beginning by the investment giant Buffett and Munger. And later on, I was really, really lucky. It was just a stroke of luck that you can't even make it up in fictions. That I strike a good connection with Charlie Munger, and he became an investor 2003, 2004, and we've been partners since then. Basically, he has been a mentor, an investor, a business partner, and a great friend all these years. And for many, many years, we have dinner every Tuesday night. And so there's my version of a Tuesday night with Charlie every week. that lasted for years until just right around the pandemic. And we talk a lot more. So obviously I had a great deal of influence by him. But I have to say that the greatest influence from Charlie was really beyond just investment. It was more of a role model in the way he conducted himself in real life. Now, I think for every profession, for everybody, it is wonderful to have role models in life. And often we find role models among the eminent dead because it's safer. So it's pretty risky to pick a role model that's still alive. And I always have a risk of disappointing you. But in my case, I got really, really lucky in the sense that my role model never failed and instead continued to inspire me right into his 97th year, basically. And so mostly it's really basic his attitude towards life and his ability to keep equanimity, in a sense, in the face of up and downs, success or setbacks. And I witnessed quite a bit of them over the 17 years or so we've been working closely. Retain that rational composure, commonsensical approach to all problems, investment or life. That is extraordinarily hard. And it is a bit of against our natural tendencies. And I've really watched up close and personal how Charlie have conducted himself. And it is in that regard that he is probably the most influential person in my life. And I have been very, very lucky in that regard.
Okay, so in this concentration in sort of now investing in great businesses, can you be specific about what kind of business you look for? What are the characteristics of a great business in particular? What detailed characteristics you look for? And how you put a value on those businesses?
Yeah. Well, great businesses are the ones who really have above average returns to invested capital. But that kind of businesses usually attract imitators, competitors. Everybody wants to have above average return to their invested capital. And so truly good business is the one who can fend off competitors, who can really have enduring competitive advantage and cap that higher than average return on invested capital, and hopefully also have a long runway of continuous growth. Those are the businesses we're looking for. And they could really come in all industries, in all shapes and forms. But they're rare. They're really, really rare. To have a business that generates above average returns over a long time on a compounded fashion is really against the natural orders of things. It really, only a small slice of all businesses belong to that category. So if you're really lucky enough to really find one of those long-term compounders, all you have to do is really to own them and own them for the longest period of time. Now, it helps when you really buy them at the time when they happen to be treated at a discount to their intrinsic value, so that if you were wrong about them, you won't lose money, and if you're right, you have more returns over time. But over the longest period of time, if you do own them through the up and downs, your return roughly approximates basically the actual business return to the actual capital invested in the business itself over the long term. The two tend to really converge pretty closely. And so understanding and studying the nature of that business, the dynamic of competition is of really the most important thing as the investor and as a student of the business. And as I said, there isn't really a set of things that really make them that way. Every business really built their fortress slightly differently. And you just have to really truly be honest with yourself and study from every possible angles until you're really convinced that the edge that they're currently enjoying truly are enduring, and they truly have a long runway ahead of them. And if they prove to be exactly as you predicted over the years, we really want to really stay on them through the up and down, thick and thin, not to be really dissuaded easily.
Okay, can I actually talk a little bit about those businesses? I mean, in limiting competition, and I think Charlie Munger is the master at this, you're really interested in moats. That is the barriers to entry into the business, because it's keeping people out that's going to limit competition.
Yep.
If you think about a moat, there are probably two elements to that moat. So think of it from the point of view of a company trying to get into the business. One is economies of scale. How big do you have to get? How big a market share do you have to capture in order to be viable as a competitor? So in automobiles, in the global automobile market, it's really large. And if you get 1% to 2% share, you're going to be fine. In other markets, like, for example, local distribution of caffeinated soft drinks, you got to get to 20 to 25% of the market to support the infrastructure that you need and to compete. So the first thing is economies of scale. And the second thing I think, and again, I'm sort of thinking about Charlie Munger here, is how hard is it to get that market share, which is all about customer captivity in a contested environment where unique technology will help you with that and so on. So suppose you got to get to 25% share. We know for caffeinated soft drinks that 0.2% share changes hands every year in a contested market. So to get to 25%, you're talking about 125-year moat. Do you do a calculation like that for the companies you're looking at? You look at those two elements explicitly?
Well, that and more.
Okay. So, then what's the more?
No, the scale is important. There is a scale economy in those businesses. Not everything actually have a scale economy. So sometimes the scale becomes a counterpoint, make it actually more difficult to really manage. But in a scale economy, the scale does really become a competitive advantage. And then, but the dynamic would change after a certain scale. You mentioned automobile. That's an interesting example. You know what happens in different phases of the industry. The consumer side is also important in a sense that if you have quite a bit of consumer addiction to a certain products and brand loyalty, obviously that is important. And they're good for a long time until they're not good. Things do change. New product categories would come along and brand get tired and old and not refreshed. New generations really don't like to have the same taste as their parents and grandparents. So that's really the most interesting aspect of businesses is what is only constant is the constant change. All great business changes over time. And perhaps really no business who can really remain that competitive edge for forever. But some of the business really can keep it for a very, very, very long time. And of course, when it changes, it's really upon the management team to be able to really reallocate capital towards those businesses actually now enjoying a robust competitive advantage. Now, take an example with Berkshire. It started out as a lousy businesses, losing businesses of textile in New England. And Warren and Charlie skillfully really took the last bit of the cash flow and skillfully invested in some other businesses really on the right side of the trajectory. But over time, some of those businesses began to lose its competitive advantage, and then they took that capital and allocated to the ones that. So obviously, the management and capability of allocating capital also plays a very important role. And of course, that the culture of a company in the industry that's rapidly changing, so that you're always a few steps ahead of your competitors, which allows you to always surfing on the edge. That also becomes enduring competitive advantage if that culture endures. So in every specific businesses, what really make them successful are very, very different. And they change over time. And so that is the most fascinating aspect of the competitive dynamics. And also the most fascinating aspect of being an investor.
Well, how do you today, as of today, Lulu, how do you do this differently, would you say, from most other investors? Are there things that you look at specifically? Are there ways that you approach companies? Now, I'll tell you the thing that when I started investing with you, and I'm honored to say that I made a lot of money doing it, that appealed to me was what you mentioned in your introduction, which is small. That small businesses or small markets are necessarily markets where you have to get a big share because one firm can dominate. And that's not something that most investors look at. So in what other ways do you do things differently from most other value investors and investors?
Yeah, well, you're right. When you invested with me, or you began to invest with me, thank God you're still with me. So thank you for your continued trust and confidence. No, back then we were looking for a smaller business because those are the business I feel I can understand them. And as we evolve, we began to look for bigger businesses that we can also understand. A bigger business does come with a whole set of advantages that, if they are right, in a sense, they also come in with a whole bunch of problems. And so we're not really looking just big or medium or small. Size is one consideration, but it's not the most important. Certainly not the determining factors when we're looking for businesses. There are big businesses because of a certain dynamics are still growing at a robust pace that are becoming even more entrenched as they become bigger, and they still have long runs of growth. So that just exists. You know, the most recent phenomenon of the technology platform, because of the network effect, some of the businesses are fitting that characteristics. Now, they don't necessarily always grow forever, but they have been growing for a long, long time and likely to continue for some time. And so just the size itself is certainly not the most determining factor But
then what other dimensions do you do things differently today than other investors who are less successful?
I don't spend my time studying how other people are doing that. We spend most of our time studying industries, studying specific companies. We're looking for the ones who are already successful, try to answer what really make them successful. Can that success be continued? And some of the time we have answers, and some of the time we don't. We just continue to really study them and continue at it until we have an answer. I think one thing that is always important for us is this intellectual honesty. Basically knowing that we really don't know what we do know and what we don't. In other words, if you claim a circle of confidence, you have to understand the edge of that confidence. You have to know what is false in, what is false out. You have to be very honest with yourself. So we really insist on knowing inside and out a particular businesses, and to the point you're able to predict its outcome, for example, in the next 10 years. At least I want to know, at the worst case scenario, what the business will look like 10 years from now. And so we do have a long-term horizon in terms, we can't really predict it forever, but I want to say what I can predict with a very high degree of confidence, say 90% of confidence, that at a minimum what the business will look like in 10 years, given all different contingencies. And so, and most of the time, by the way, we don't have an answer. And we just keep studying, keep at it. And sometimes we study for years and years before we see, okay, we really get it. And then we wait for price to come to our striking zone. And a lot of the time they don't. And so that makes our selection very, very difficult. And so when we do select them, we tend to really own them for a very, very long time, because the businesses, they're really good and we really fully understand are very rare. And how do you mean when you really do understand that? So anything that we would own, we would buy a lot more as they go down. And
now, how do you, sorry, go ahead.
Yeah, if they go down 50%, 60%, 70%, we buy more. So that really gives you a measure of our definition of whether we understand them.
Okay, so what about the market today? I mean, it seems highly valued. I mean, if you look at fixed income, it seems unprecedented. That said, does the market today remind you of any historical periods you've lived through in good ways or bad? And would you have advice for anybody on how to navigate?
Well, we usually don't study too much about the market, except when they're really extreme. And this has happened to be one of those more extreme period of time. It is truly, in many ways, we're in uncharted territories. The amount of liquidity that's been printed, the level of interest rate, and also the slow pace of the growth. All of those are quite really remarkable in this period of time. So how do you really deal with them? We don't necessarily think that history will repeat. And so every time is slightly different. Instead of guessing the patterns of history and whether they will repeat, we focus on selecting companies that can really live through the thick and thin. Whatever the environment, business will continue. Somebody will do well. So we just want to really invest in those companies who's capable of dealing with those extraordinary set of uncertainties, and we're doing fine.
And how much is management a part of that? And how do you look for managements that have that capability?
Well, in a lot of the companies, the management will make big differences. The culture that the management will produce will make a big differences. But in the small set of experiences, management really matters almost nothing. But the strengths of business itself really has a dynamic of its own that really almost anybody can run it and run it well, relatively. Now, those businesses are really rare. There are not that many. You can probably put them in one hand or two hands. And so again, I come back to the situation. Each time is different. You have to really look for each specific company in specific ways and ask all kinds of probing questions and study them over a long period of time in order to really honestly say that you actually understand them enough you can predict the outcome in 10 years, even given all the up and downs in the macro environment.
So you've lived through, in your 23 years running Himalaya, a number of major financial crises, the Asia crisis in 97, the tech bust in 2000, the financial crisis in 2008, and actually last year, the COVID-19 situation. Yeah. Are there specific things you learn about managements or companies that you look for in those crises?
Yeah. Well, so as you said, in my 24 years of managing Himalaya Capital, we have gone through several of those big crises. each time when that happens, it was billed as once in a century crisis. It probably was, except it happens on a time frame of every 5 to 10 years. So the financial market boom and bust has been a constant phenomenon since the beginning of the financial market several hundred years ago. And it was driven by human nature. As long as human nature remained that way, it would never change. It will always be with us. As a product of evolution, we humans are basically run not necessarily in a very rational way. Now, we're very good at rationalization, but we're really not very good at being rational. So we always are looking for, in a sense, we're governed by some set of hard-coded instincts. And we're looking for a zero sum, and we're looking for fast money. And then you got really totally scared when things goes against you. So that's basic sense of greed and fear would always drive the financial market up and down. Particularly when it comes to money, humans are very funny in a sense. They tend to evoke the primal part of human nature. And so particularly related to financial market, a security market, money, that human tendency of the extreme instincts become more amplified and more extreme. And that's why the financial market from the very beginning has always been characterized by boom and bust, and will remain so. Now, how do you deal with such an environment that will be constant? Well, one way to deal with that is to anticipate that always on the corner at all times. And that's basically our attitude, that financial crisis will happen all the time. People will always be driven by fear, by euphoria, by this extreme kind of up and downs. And so we're looking for businesses that are capable of living through that. And even businesses that could really thrive in that environment, in a sense, have a certain characteristic of anti-fragile. And so that up and down becomes somewhat friendly for us, in the sense that when our favorite company is on sale, discounted by 50, 60, 70%, if we have money, we'll buy more of it. If we don't have money, it is a hallmark of a good investor. You can sit through watching your portfolio down by 50% and not being affected at all. On the other hand, other side of the coin is that you're equally unaffected when everybody around you are making fast money, fast and furious, a lot of them. And you're really seemingly totally left behind. And so, and that's really part of the temperament that most people don't have. And that's why not everybody can succeed in this game of the investment. And so to succeed in this game requires certain temperament and a certain understanding of human nature. Also, a certain commonsensical approach, and knowing that an investment return eventually will mirror the actual business return by actual businesses. And we know in real life, in real businesses don't really change by day, by hour, by week, by months. It took years for them to really either go up or down. And so you should expect your investment result to come in over slowly, gradually over a long period of time. So the short-term phenomena should not really impact you as much, either on the up or on down. And so if you have that basic temperament and basic approaches, what you're going to find is that both the euphoria as well as the crush actually can serve you well. And this is really going back to Ben Graham's basic concept of Mr. Market that is there to serve you, not to instruct you. Except in real game of investment, those phenomena, both on the up and down, tend to be quite extreme in testing. And so the other thing that will be very testing is that you really do need to understand the business itself. And if you really try to pretend you understand, and you're really driven by something else other than deep understanding, you'll be tested. And so that's the salient nature of the financial market. I sometimes almost feel that they exist to catch human weaknesses. That if you really don't understand something that you pretend to, you will be busted at some point. But if you truly understand, you will be able to add when the security really down 50, 60, 70%.
Yeah, can I actually talk a little bit about a specific example there and maybe get you to talk about an example? Because one of the things that you talked about was the stability of these companies and their managements in the face of a crisis. So a crisis tells you a lot. And the one company that obviously recently has done extremely well, and you could see it, is John Deere. So if you looked at John Deere in 2000, demand fell by 5% and their profit margins fell to zero. If you look at what happens to them in 13, 14, demand falls 35% and their profit margin stays at roughly half what it was before, which is higher than it had been historically. So clearly that's a company that's changed, and in the face of sort of catastrophic external conditions, has gone from doing quite badly to doing much better. Do you have examples of that from the companies you've invested in where you've seen them perform through a crisis?
I do. Over my 27, 28 years of investment, that's the kind of things you collect. But normally we don't talk about specific companies.
But could you share maybe a historical experience of that so that the students in the audience might have a sense of what to look for in looking for this stability?
Well, Bruce, we tried this multiple times in your class.
I know. I'm going to change. It is very familiar to me.
And there is a simple logic reason why we don't do that. Once you achieve a certain notoriety in a certain field, the people tend to really copy that. And that's not the behavior we want to encourage. Instead of giving people fish, it is much better to really teach people how to fish.
Okay, so let me do one last question. Do you prefer to be a generalist or a specialist investor? And would one work better in the Chinese market than another?
Well, in a sense, you always want to be a generalist in terms of a student of businesses. That your interest, you have to have to be good at this game. You have to have the innate, intensive curiosity about a business, all kinds of businesses. It doesn't mean you're going to really, really get to the bottom of it. Oftentimes you don't, if you're honest with yourself. But by the time you really get into the companies you really decided to invest, you really better become a true specialist. And to the point you really know, hopefully better than anybody in the world you can find, including the top management team. And the top management team, because they manage the company, they tend to be deeply personally vested in their own biases and may not be able to look at the business as objectively, rationally as you do. And so that's a really test. So you want to be a true specialist in the company you chose to really invest. But you want to be a generalist always of business in general, so that your core competence, your circle of competence can constantly evolving and enlarging over time. If I still really know what I knew when I started, when I first took the class, or when you first invest with me, we will not really have anywhere near the result that we both enjoyed. And so luckily that we continue to expand, we continue to learn. But on the other hand, it is fascinating to see that how business evolved over the last few decades. will continue to evolve in the next few decades. And that really makes me feel that, boy, I'm lucky to choose this field that I get paid to really satisfy my curiosity and to learn all these great people and great enterprises serving society. So I feel happy every day doing what I do.
Well, okay, so let's talk about the evolution of markets. And in particular, at a 2010 panel at Columbia Business School, you mentioned that Asia's role in the global financial system was becoming increasingly important. Looking back, how has Asia's role evolved in the last 10 years? And what about China's role going forward in both the world's business economy and in the financial system?
The word is to turn out exactly as we predicted. Asia indeed to become a lot more important, in particular China in it become even more important. As I look at in the next few decades, I would say that the Chinese market and Asia in general will become even more important. The set of the dynamics that are already set in place will continue to play out in a robust way. So the Chinese security market in general and Asia economy will become increasingly a very, very important, ever more important component of the global market.
Well, all right. So let me give you some data that I don't think is widely appreciated. I mean, the Chinese numbers are obviously very difficult to interpret, at least the official numbers. And whenever you see that from a company, the data you really want to look at is the data where there's a reliable counterparty. And the trade data is where there's a reliable counterparty, because every Chinese export has to be an import from another country, and every Chinese import has to be an export from another country. Over the last 8 to 10 years, China trade has grown by only about 2.5% a year. That's less than 1% faster than US trade. What does that say about Chinese growth? I mean, that's clearly much slower than the trade growth prior, say, to 2010, 2011. And it's fluctuated, obviously, but if anything, it's been slowing down. What does that say about China's future?
Well, it tells you that the characteristic of the Chinese economy has changed fundamentally. You know, up until 10 years ago, what really propels the Chinese growth was international trade to a certain extent. And I would say back in 2010, the net trade, meaning the export-import netted out, was roughly about 9% of GDP. And so Chinese economy was heavily dependent on the global market. Now, what happened is that, and they were growing at really double-digit growth at the time when the rest of the global economy was growing at much, much less, a fraction of that. And so at a certain point, once you become the largest trading nation, you can't really, the rest of the world wouldn't be able to keep up. And the other thing that's happening is after the citizens become middle classes, their demand changes from basically just work, saving, into really work, saving, and consuming. It is just also human nature. So roughly around 10 years ago, as you point out, the Chinese economy has slowly evolved into more of a consumer-driven economy. To the point that, interestingly, last year was a watershed year in a sense that the retail sales, the total volume of retail sales, for the first time overtaken the United States. China was the largest retail market in the whole world at $6 trillion or so US dollars. The US is roughly 5.5 trillion. Now, granted that that was a special year in the sense that a global pandemic hit other countries harder than China. It's also said that China has done a better job in managing the pandemic. But basically, the trend is there. China is emerging to become the most dynamic, fastest growing consumer market in the whole world. And that is likely to continue for many, many more decades to come. And so that really makes China even more attractive to the global economy in terms of people who want to sell to the consumers, to the middle class in China. And the characteristic of the economy will change and would also really provide unique and interesting opportunities for global investors.
Let me just talk a little bit about that. I mean, the thing about retail sales is that it's selling goods. The thing about the developed economies is that they're overwhelmingly service economies. They're not goods economies. And on that dimension, it doesn't look like China's doing particularly well. And as I say, the export data, you could understand that would slow down. But the fact that the import data has slowed down just as much or more tells you something about the nature of domestic growth in China. What about the challenges in the service sector in China?
Well, you're certainly right that at the current stage, the service sector has yet to become as powerful and dominant as most of the matured, developed economies in the West. And that's really lies a new set of opportunities for the decades ahead of them. And that's, by the way, not that much different than all the other developed economies at a comparable stage of a development, say at a $10,000, $11,000 per capita GDP, which is where China is today. But if you look at the underlying dynamics of the various different businesses, different performance, both consumptions, retails, and the service are basically the ones that are growing the fastest. And overall trade internationally is still growing at a robust rate, but not nearly as much as the domestic side of the economy. And so that's why their share of the GDP has gradually begun to shrink. So domestic consumption becomes far more important, both goods and the services, as you point out. And so that just tells you that a different stage of the economy where it is today.
So where do you see the unique challenges and opportunities instead of finding value investment opportunities in China?
Well, China remains, I think, one of the best market if you're a value investor. In a sense, the market is still somewhat underdeveloped. The market today is not as representative as the real economy the way, for example, United States is. And so there's a lot of development in that regard. And the trading and the investors are still not as mature, and there's still a mentality of fast trading, high turnovers, which actually renders some of the companies, again, going through a faster pace of this boom and bust. Again, that usually provides opportunities for those mature, patient investors who truly know what they're doing. And also, as you said, the service sector of economy, when it comes to financial services, is still yet to be developed. And China was really right at this stage when the financial service industry actually is about to take off in a big way for many reasons. And it just so happens also the Chinese government is quite keen in making macroeconomic policies quite conducive for the development of the financial service industry. And they began to open up to the global firms as well in a way they've never done that before. And so all those confluence of factors really make the market that much more attractive today than it was before.
Yeah, can I say something about that? Financial services is probably the fifth or sixth largest service sector. The biggest is housing by far. The second biggest is medical care. The third biggest is education. And the fourth and fifth biggest are like wholesale and retail distribution, and then personal services, and then financial services, although in the US it's a little higher than that. What about those sectors in China?
That sector is also growing.
Right, but do you see opportunities in?
Absolutely, we do.
Housing?
We see opportunity.
Shelter support?
Basically. virtually every industry are going through a robust growing stage, some more than the others. And even if industries are not growing as fast, you can still find interesting companies, values. And I don't have to, you're the guru for this field. And so different people tend to focus different aspects of the industries and different aspects of the growth profile. Some looking value at high growth companies, some looking values at moderate growth companies, some look value in places that doesn't grow at all. In fact, they're probably declining, and therefore they find even bigger markets. So if you are a true good investor in a sense, you can find value everywhere. But you're probably more capable of finding values in a dynamically growing economy such as China. They're still growing at multiple times of the mature economy in the West. And there's still enormous amount of inefficiency in its security market. So that combination of those two really make it enticing. On top of that one, a whole series of government reform will make those inefficiencies gradually be more efficient. And so that transition offers even more interesting opportunities. So this is a good time for global investors. And certainly for U.S. investors as well.
Okay, in those terms, that as Chinese financial markets are developing, do you have certain reforms or other things you'd be interested in seeing implemented? Do you sort of have a top development that you'd like to see happen in the China financial markets or even in the China economy?
Well, in a sense, it's already happening. And that's what I mean by the Chinese government and regulator has been very keen in developing the security market. For years and years, the Chinese security market is not very representative of China's economy, partially because it really, the IPO rules are based on what they call approval model. You have to go through lenses of approval, layers of approval process in order to be listed. And so the ones who listed are the ones who really approved by government for whatever reason, sometimes often not really market driven. Compared with other markets such as the United States, that it is based on the registration based. And so it's market driven. As a result of the financial market, the security market here are quite representative of the true economy. And as the Chinese economy moving from a export-import driven economy into more of consumer demand economy, the entrepreneurial companies with market-driven dynamics are increasingly play a larger role. And therefore, this financial market have to reflect the changing dynamics. And the Chinese government is determined to reform its IPO process from one of approval process model into one that is much like the United States of registration-based model. And so we are probably still early in that process. But as that process began to play out, we will see the financial market become more reflective of the real economy. And the other big changes that is happening is that most of the financing are done through the banking sectors up to the point 80+%. And over time, the financing is best to really do through what they call direct financing, mostly through market-driven dynamics of fixed income, equity, et cetera, And so we see the overall financing model of the Chinese economy from one that is more indirect into more direct. And so thus is the reason for opening up this financial service company, financial service industry, both for domestic players and global players. As we're seeing that dynamic plays out over the next decade or so, there will be a lot more opportunities. And the financial market will become more mature, and there will be more institutional players coming into it. And the financial market size will become much, much bigger than what it is today. So those are really all bode well for investors who truly understand what they're doing basically in China.
Yeah, let me ask another question in that connection. I mean, the thing about a service economy is that services are overwhelmingly locally produced and consumed. There are very few global universities, for example. There are very few global high schools, very few global hospitals. That means that typically, if you look at developed economies like the United States with big service sectors, the firms which tend to be local, the service firms that tend to be locally financed. So I assume you know that local banks in the United States are much more profitable than the big global banks. Do you see a comparable trend developing in China that you can take advantage of?
Some yes, and some no. I wouldn't say that the local banks in the U.S. is really
no, but I'm just thinking in terms of local experts within China in local service businesses, and that would include, of course, local banks.
Yeah, well, they tend to really know the local area, but the Chinese regulation of banking is slightly different. So there are only roughly about 15 banks that really have the mandate of being able to take deposit on a national basis, and all the rest of the financial institutions are able to really take deposit in a very, very small, well-defined local region of their town, of the villages, of the cities, et cetera, et cetera. And so it is a heavily regulated businesses. And so that really gives them almost oligopoly type of a status in terms of taking deposit, which is very important, of course, in terms of the source of capital. So that dynamic is slightly different than the United States, for example, that the license ability to really be able to open a bank is much, much more relaxed in the United States than in China. As a result, basically the dynamics of the larger national versus local or regional banks and other financial institutions are more driven by basically the business dynamics, the market dynamics. And this is very different than in China. It is driven first and foremost by regulation regime. And so that makes the comparison of the banks really quite different in China than the United States.
So would somebody investing in banks in China have to be an expert in Chinese regulation?
Absolutely.
Specialist.
Yes. If you do decide to invest in anything, I recommend you better become the most knowledgeable specialist on the planet before you're really interested in really invest and own them through the up and downs and thick and thins. And if you do understand them, and they are good, it is far more profitable to own them over the long period of time.
Okay, so why don't we talk more broadly about new trends in value investing? So among the many popular and uprising technological fields such as 5G, Bitcoin, AI, has any of that attracted your interest as a value investor, and why?
Well, as I said, if you're an investor, you really want to find out what really influenced the change of your companies. If there's one big forces that are really quite prominent, is the fast acceleration of technological changes. And of course, you need to be well aware of those mega technological trends. It's this current wave, and it started call it 40, 50 years with the invention of semiconductor, particularly the integrated circuit. That really ultimately led to personal computer and the computation proliferation of the computation power to ordinary citizens. And from there, there's also the evolution of communication technologies, and then the invention of the internet somewhat 25, 30 years ago. And from there, the mobile internet. So the intersections of compute as well as the omnipresent and instantaneous, basically, communication really led to this new phenomena of artificial intelligence and the data economy as a result of it. And so this wave of technological change over the last 40 years has fundamentally altered the business landscape of all kinds, basically. And so whatever kind of investor you are, we do need to be aware of that huge changes. And how do you deal with that in a sense? Well, you're investing in businesses that are either well insulated from those technological change, or in companies whose management team are quite capable of adaptive to those technological change better than their competitors, or in companies that are leading those changes or enabling those changes, so that those changes are really on your side, basically. And so now, do you have to be a true expert to the point of an engineer? I don't think you do, but you do need to be broadly aware of all those big technology changes. Now, if you happen to be a venture capitalist in those fields, of course you do. But if you're a generalist and study all the businesses, you need to be aware of those trends. How does it really impact in the industry and the companies that you're investing in? So we are still really at that, in the middle of that gigantic wave that started with the invention of semiconductor 45.
By the way, you know when the transistor was invented?
Well, that's a longer, I know.
Yeah, that was 1942.
Yes.
And the first ICs were 1961.
Yes. I'm referring to the time
right.
really get integrated into industry. And so that's, that really started this whole revolution. And we're actually still in the middle of it. And the current wave of neural network-based artificial intelligence is just kind of the recent iteration. And the data economy that as a result of it is a newest adaptation by industries in response to that new technology. We're going to see more of it as time really began to evolve from here.
Do you see opportunities to invest in new technologies? Do you have an example maybe in your past where you did invest successfully in a new technology?
We have, in a sense. Back in the days I was trying to really learn about businesses, I invested in a number of startups. And so I am fascinated about the technologies. And today we have somewhat smaller exposure to that. But it is fascinating. It's not really, you're not interested in technology. It's just, it's not that easy to predict or impact because of the pace of a change. It does require different aptitude, different domain expertise, etc. Other thing is we just have other set of easier opportunities. We just happen to be lucky. Yeah.
Well, all right. So let's talk about a specific example. A lot of smart people believe that renewable energy is the next big revolution, and you've done a lot of work on battery technology and BYD. So is that something that you think about beyond batteries? What's your outlook for the electrical vehicle industry, say in the next 5 years, or is it overheated now? Where is Tesla going?
Okay. So the car industry is simultaneously kind of being impacted by 4 or 5 big mega trends: the electrification, the ride sharing, the autonomous driving, and the intelligent design. All of those really going into the industry simultaneously. And so that really had attracted more entrants. and that really heated the competition. Also against the broad background of climate change, carbon neutral revolution in the sense. So as a result, the industry that really have lasted for 100 years is really being turned upside down. On the other side, it is the gigantic industry. So other than housing, that's probably one of the biggest industry. So the price is also big in the end. In the process, though, the competition is going to become very, very intense. Still, it does still have that characteristic of being a scale economy, as we talked about at the beginning of our dialogue. So the survivors or the winners do need to have a certain scale in order to really to win in the end. And so it is still early to predict who will be the ultimate winner. But it is not early at all to predict those mega trends are here to stay. So 5 years, there will be far more electric cars sold. We have seen the European countries began to declare a deadline to stop basically gasoline-powered cars. China is following that up, I think, in due course. That we were going to see those mega trends here to stay. And 5 years from now, that trend will become even more prominent than what it is today. But it is very difficult to predict the ultimate winner, and it continues to attract new entrants at this point. But I do think that the ones that really possess unique technology, have the scale, and have the right strategic focus, ultimately will do well.
Do you have a sense of which companies those are?
Well, I bet one. So, so I like my money speak for itself. But we're not going to be the only ones. So there will be a few. It is a gigantic industry.
Okay. So in terms of value investing education, you actually played a big role in promoting and advocating value investing, from the books to actually you underwrote this class that we talked about where I went to Beijing University, and I think it still survives.
Yes.
What's your vision for the kind of education that a new investor should embrace and where that education might be available?
Well, first of all, thank you, Bruce, for coming to teach at the Beijing University Value Investing classes that my colleague, Gene Chiang, and I started 6 years ago, and now is 6 years still running and running very well. And you have played an important role to that. And I think our original inspiration for that class was really based on pretty much your class. And your class is pretty much inspired and a continuation of the Ben Graham's class, Graham and Dodd, which had, among others, Warren Buffett as student, and I'm your student. There will be many more, much brighter investors coming after us, and that's a good thing. So we're trying to really do our part to pass on both of the philosophy, the thinking, and the practical arts of value investing to the next generation, in a sense. So in terms of younger students, when you started today, so I think a few things will be important. When I talk to young students and people who started out trying to get into the field, I say several things that is important. A, to always adopt a owner's mentality. And so I like to really ask a young student or an analyst at our firm basically to imagine that all of a sudden that one of your unknown uncle died and handed over 100% ownership to the company to you. And that's the business you're going to study. So any company, think starting point that way. And once you really kind of think that you own 100% of it, your mentality is totally different. So you never know that business existed. Now you own 100%. You have no idea how to run it. You don't know the people who run it. what do? You want to know everything you can possibly get your hands on. And a lot of the things you don't understand. You just know the facts. You don't understand it. But that's okay. You're going to continue to learn until you get a handle of it. And even if then, because of the constant change, you're going to continue to evolve your knowledge of it. Now, if you adopt that mentality, study any businesses, you have really started the process of becoming real value investor. So that's the first thing. The second thing is you really want to maintain intellectual honesty. And that is very, very, very important. You have to be really honest of what you know, what you assume, what you pretend subconsciously, and what you don't know. And how do you really know that? One of the things that Charlie have talked about that I think make the most sense is he always said that I'm never entitled to have a view until I can find the smartest people on the planet who took the other side of that view. And I can argue better that opposition than he does. And when I can do that, I would be entitled to have a view. Same thing and applies to investing in the sense that intellectual honesty is a good life philosophy to begin with. It is a critical, it is a vital when it comes to investment. Because as I said, the security market always exists to really point it, to find your weaknesses, your dishonesty, your pretension, your wishy-washy knowledges. And if you do not really possess that fundamental attitude of intellectual honesty, you'll be destroyed at some point during your career by the financial market. It was almost designed that way to catch you.
Can I say something about that? Because it was better than designed that way.
Okay.
Every time you buy a security thinking it's going to do well, somebody else is selling you that security thinking it's going to do badly, and vice versa. And one of you is always wrong. So you better be sure that you're the one that's on the right side of that transaction.
Well, there is some zero-sum aspect, but not always.
Oh, no, it's 100% zero-sum. The average return to all investors in any asset class, and therefore in all asset classes, is the average return to all those assets.
Hey, Bruce, I would just take a slightly different view, but I'm never going to argue against my professors.
I'm just going to say.
Let's just agree with disagree on that point.
Okay.
That's okay.
That's fair. Okay, keep going.
But it's a fair point. It's a fair point. And the third thing I would say is that you want to really devote as much time as possible to a study of the history of the businesses and the history of great businessmen in the past. The more you study more companies, the better you are when it comes to judgment on good opportunities and the judgment about the fundamental characteristic of the company you're interested in. And so I say all three things are important: to start with the 100% owner mentality, to continue to train yourself to have a high degree of intellectual honesty, and lastly, to be a thorough student of the history of the businesses. All three things are really going to be very helpful if you are beginning to get into the field of investment, or you want to really improve your game. So that's my advice to the younger student.
Good advice. I'm not going to argue with that.
Yeah.
When you look back over your own career, are there things that, whether at Columbia Business School or in your career since then, you would have done differently that would have helped you get to where you are today sort of more quickly and more easily?
Yeah. Well, I look back, I feel I'm extraordinarily lucky, and I feel nothing but gratitude. I feel lucky to accidentally step into Buffett's lecture at your class, basically. At the first time he came, I feel extraordinarily lucky that I got into the business and the striker relationship with Charlie Munger. I feel extraordinarily fortunate to live in a period of time when both United States and China are going through fundamental economic growth and provide enormous amount of opportunity that I happen to really know both markets well. And so I looking back at my career with nothing regret. I feel nothing but really gratitude. But in terms of on the transition from U.S. to China, so I think a lot of people, such as myself included, went through a period of time to really try to understand the nature of the Chinese economy, the nature of the Chinese market, the nature of the Chinese company, investment in Chinese companies. So one of the key learnings that I have, and it is not that obvious, is the role that the Chinese government played in that whole equation. If you have been a successful investor in the United States, for example, or in the developed market, you tend to come with a set of assumptions about the role of the government and the role of the market participants. And when you really look into the Chinese market, that assumptions, you will see a lot of challenges. And so you might really, from time to time, arrive to views that are inconsistent with your own experiences, partially because historically the Chinese government and the US government, the Western government, perform a very different roles. And that's one of the key aspects of really investing in China. It really requires much deeper understanding and also systematic comparison to get rid of those biases. And that's why that you can really get rid of this typical global investor going into China, either bowled by the euphoria, enthusiasm, or basically pessimistic kind of coming collapse of a China type of a mentality when things are not going too well. And so that is the education that most of the international investors, particularly when it comes to China, would have to really go through, and that is important. But bear in mind the other aspect to understand the Chinese economy is that the nature of the modern economy is its ability to generate sustained compounded economic growth, something that is only recently emerged as a human phenomena. And this is where we talk about the zero-sum versus a win-win type of mentality. Now, for the longest period of time, that almost all natural or human affairs are characterized by cycles, in a sense, that everything goes up cycles. You know, we born and and then we grow and then we die. So the trees, it goes up and they die. So entropy basically always increased. Energy goes from hot to cold. Things from order to disorder. Great business has eventually lost its edge. So that has been the nature of things. An economy going through boom and bust. But something unique happened over several hundred years ago with the beginning of the Industrial Revolution. We began to see this phenomena of continued, sustained, compounded economic growth. And that is really when value investing becomes very important. And that's why you begin to have a phenomenal record, such as the one produced by Warren Buffett, and now by a few other people as well. The basic logic behind that, as I said, over the long term, your investment return is likely to approximate the actual business return of the company you invested in. And so the fact that you're capable of generating that long-term result is a reflection of a changing nature of the economy. What really drives that phenomenon is something that is utterly fascinating. I literally spent 30, 40 years thinking about that one until I think I come to a certain knowledge. I wouldn't say I really know it all, But I think what really produced that phenomena is the combination of free market enterprise way of organizing social economic affairs, and combine that one with the invention of modern science and technology. The combination of those two produced a modern form of economy. It is a paradigm shift. So what has happened in China is that roughly around 40 years ago, China has really stumbled finally into that magic formula of free market economy. Now with Chinese characteristic, of course, along with modern science and technology. And any economy that has really struck a chord and struck that magic formula began to produce the phenomenon of compound economic reform. Now that has to combine with the stability of the overall political environment to allow the market force, that a new economy to really release that power. And that is when sustained sustained investment record can be possible in China. It's not always there. It's not always possible. And often it was a zero sum. But I think from that period on, that a sustained win-win type of a compounded investment return becomes possible. And notice that I didn't really include the political component of it. And most of the Western observers believe that political democracy has to be part of the equation, except they forgot that political democracy wasn't there when that phenomenon began to take place in the West. In fact, the political democracy happened later, almost as a result, but not because of it. Anyway, so that is another layer of understanding the phenomena of investment opportunities in China that could be interesting.
Okay, so what about, let's just talk briefly in these last 8 or so minutes about your personal interests. So you've devoted efforts to improving equality and welfare of Asian Americans. And given the recent elevated attention on this community, what are you doing and planning to do or think ought to be done for that community?
Well, I was really, like many people from the Asian American community, an American that was just utterly dismayed, heartbroken over the last year and a half, particularly since the later years of the Trump administration. It got worsened because of the pandemic, this new wave of anti-Asian hate crimes. And by all statistics, that incidence of racial discrimination against Asian Americans has dramatically increased over the last year and a half. And for a variety of different reasons, the pandemics, the Trump policies, the US-China tension, and the systematic historical root. Suffice to say that many people in the Asian American community are living in fears, literally physical fears today, after being here for so many years and being such an important part of American experiment. And, particularly to the Chinese American community, after 150 years, it feels like the Chinese Exclusion Act is coming back again. And so I've been thinking long and hard, what can we do to change the paradigm? Now, I had different experiences when I came to America. I had a wonderful, wonderful experiences. America embraced me with open, warm heart. And I have gotten an enormous amount of opportunities by Columbia University, by all the great people that I met along the ways, and by the opportunity I was given to be successful way beyond my wildest dreams when I first came here. As an immigrant, not a penny, nobody doesn't even speak the language, to be where I am today. And so one thing that I always believed about America is this. I think America is not defined by geography. It is not defined by race. It is not defined by culture, not defined by religion. America is defined by a set of ideas and ideals. Anyone, no matter your race, religion, culture, background, if you sign up to that set of ideas, ideals, can be American. And I was one of those who believe in those ideas and ideals and have become successful in America. And I wanted that experiment to really continue. And obviously, when you look at history, it was never a perfect experiment. And it was often marked by the clumsiness, sometimes actually outright cruel and malicious, if you think about it, experiences with the African Americans and all the other minorities. But I think America remains the only country on earth so inspired and such constructed. And for that experiment to continue, it calls constantly to our better angels inside each one of us and to really restrict the worst instincts of all of us. And throughout a different period of time, people need to rise up to counter those worst instincts and fight them and face them down. And this is one of those periods again. So I think the entire community of Asian Americans have to come together. The entire American community need to really come together to really fight this wave of anti-Asian discrimination. So along with a number of wonderful colleagues, we are co-founding a new national organization whose mission is to serve Asian Americans in their pursuit of belonging and prosperity, free from discrimination, slander, or violence. And one of the things that our community needs is enormous amount of funding. The statistics tell us that only 0.2% of all philanthropy in America goes to Asian American causes. And we want to fundamentally change that. And hopefully with this new organization, new group of people, we really want to fundamentally change that picture. And the other thing is that with the global economy, the center of the global economy shifting from the Atlantic Ocean to the Pacific Ocean, Asian American 20 million strong are going to play an increasingly important role to position America as the new Pacific economic power. And that group of people, more than other ones, if fully integrated as the very fabric of American society, could help lead America to better integrate it with the rising economic tides in Asia. So,
okay, Lilu, that's terrific. It's a great note to end on. Unfortunately, we have 2 minutes left. Thank you very much for this really encyclopedic and enlightening talk. I think I have to turn it back over, however, to the MC for the last 2 minutes, right?
Okay.
Because they're on the screen.
Thank you very much.
Well, thank you. It's always a pleasure, Lilu.
Thank you for really having that class, 28 years ago. Without that class, I wouldn't know what I'm doing today. So thank you.
Okay. Go ahead.
Hello, Vivian. I think I'm turning that back to you.
Vivian, can you hear us?
Thank you, Professor Bruce Greenwald and Mr. Li Lu, for this valuable conversation. This marks the end of this year's Columbia-China Business Conference. In these 4 days of discussion, we have taken a journey across various dimensions of China's amazing development and exciting future. In an age of change and opportunities, our speakers have given us a fascinating glimpse of what's to come. On behalf of Columbia Business School, our conference team wants to express sincere appreciation to all the guest speakers, sponsors, media partners, and faculties of Columbia Business School. This year's conference is generously sponsored by Bank of China, Haitong International Securities, Tiger Brokers, Johnson & Johnson, and Haitong Global. We appreciate the support from our media partners, including Yahoo Finance, Sina Finance, 财经 Magazine, Barron's, 巨浪视线, 界面, 一财, 36氪, Tencent Video, SubChina, and many more. So lastly, thank you, audience around the world, for your time and participation. Live from Columbia Business School in New York City. Good morning and good night, and see you next year.
We finished exactly on time.
Welcome to Columbia Business School, the very center of business. Welcome to the next level of you. The Columbia MBA is more than just advancing your career. This is about honing your unique leadership style, bringing your visions to reality, and delivering them to the world. You will be the leader you want to be. You will be able to walk into a room, any room, and solve. Welcome to New York, the global business hub, where startups get their start, business thrives, and game-changing strategy gets put into play. You will have direct access to today's influencers, the entrepreneurs of Silicon Alley, the wizards of Wall Street, the trendsetters of Fashion Avenue, the agents of change. Welcome to a network, a family of over 42,000 alumni. Let the collaboration begin. This is not a sit and learn environment. This is grab the reins and lead. You belong here.